They are panicking. I'm your host, Steve Metre, and thanks for joining me today. In our lead story today, political elites panic as the unthinkable is about to kick off the next financial crisis. And not long ago, these political elites said they had this completely under control. And now we're finding out it's about to get worse. And is Jerome Powell at risk of losing his job? Well, we'll show you why the heat is on the Fed chief. Plus, we have a sponsor for today's show, Telemere Pharmaceuticals. You can find them on the NASDAQ under symbol TELO, and they're looking to develop and commercialize a drug that affects age reversal called Telemere 1. And if you love chart setups that show a stock that could squeeze a rapid 10 to 20% higher, well, stay tuned to the end of the show or check out the pinned comment or description for more information. Now let's go to Bloomberg, where we picked today's story up with a headline, as China scraps Premier Lee's briefing, breaking years of convention. And this is important because in China, we're all of a sudden starting to see them continue to obscure economic data. And this is just one more move to take one of their top leaders out of the limelight of the press, because things there are getting far worse, as you're about to see. The country's number 2 official won't take questions at the close of the National People's Congress for the rest of its 5-year term, apart from, in quote, special circumstances. And this from a cohort of lawmakers that's set to gather each year until 2027. And all this means is that things in China are bad. We can note that what's happening right now shows that they are on the cusp of triggering the next global financial crisis. And everything they've done so far has done absolutely nothing to mitigate the risk. In fact, they're only making it worse. The growing opacity comes as Beijing tries to boost confidence in an economy grappling with a prolonged real estate crisis and headwinds from geopolitical tensions with the U.S. Foreign direct investment has slumped to a 30-year low in 2023, while mainland Chinese and Hong Kong stocks have lost $7 trillion during a market meltdown, despite official pledges to put support under the market and woo foreign capital. And the real issue here is the real estate market. We saw this going back into 2008 and 9 as the U.S. kicked off a financial crisis, as our mortgage industry blew apart and spread all the way across the world. And now in China, it has everything to do with their housing market and their property developers. And there's a very good reason why China doesn't want Premier Lee in the limelight, because the questions, well, they're going to be brutal. As China home sales drought now persists despite mounting support, as we see the top 100 developers are seeing a slide of 60% from a year ago of their home sales, and that is a staggering number from what we already know is a Ponzi scheme of a real estate market. Because unlike here in the U.S., when people buy a new home, they put a deposit down. The risk is on the developer at that time, because if the home doesn't get built or the buyer decides they don't want it, they strictly, you lose their deposit. In China, it's different. When you buy something, you pay for it up front. You get the financing up front. And well, if the developer doesn't finish it, you're the one that's out. And not the problem here is the developers, they're out of money in a big way. And Beijing has tried to prop this up. And as you're going to see, it's not working at all. And here we can see that sales in February were down 20.9% from the previous month, as consumer confidence in the real estate market, well, is gone. And policymakers have increased pressure on banks to boost their property loans through so-called whitelists. And this is the initial phase of what Beijing is going to have to do before they slam rates back down to zero, because their view is, look, if the developers are out of money, we just need to get them money to finish these properties, and that will restore confidence. The problem is Chinese consumers do not see a big turnaround in not only their domestic economy, but the world economy. And as the second largest country and the world's largest exporter, consumers there are looking for work in their jobs and seeing demand from the Western world is plummeting. And here we can see in a flurry of activity, state-owned lenders have earmarked at least 124 billion yuan of loans for property works eligible for support, according to the state media, again, who now wants to say out of the public eye. The drop in housing prices and job losses means the government needs to start issuing stronger stimulus measures This is important because we talk about housing markets and how critical they are in the U.S. It's very important because when the housing market slows down, it just creates a tidal wave of job losses. It starts small and then builds up steam. And in China, we're now seeing the same thing as demand for housing crumbles, as consumers lose confidence, which in turn leads to more job losses and higher unemployment, which leads to further lack of confidence. And of course, in the end, less buying. The issue then being is these banks are on the hook to these insolvent property developers, telling us that the Chinese banking system is equally insolvent. And if this all goes, it's going to spread around the world like wildfire. Another key step was broadening the use of commercial real estate loans for developers, get this, to help them repay other debt. And there's no better solution to a debt problem than saying, look, just take out some new debt and pay off that old debt. And everyone will think, wow, look at how great things are. This is just a scheme by Beijing to clear up, of course, the rot in the system and wallpaper over it without doing anything constructive to actually fix it. The government also increased support for the troubled property sector with its biggest ever cut to key mortgage reference rate, which did nothing at all and may entice home buyers as prices fall. And yet, what have we seen? No chance at all. Buyers are now seeing prices come down. They're seeing demand come down, and they're stepping out of the way of what is going to actually lead to an implosion of their economy. And now we turn to what's happening, the unthinkable. One thing in the Chinese property sector that shouldn't have happened, well, it started. Chinese insurance warned of debt risk to property giant Vanke, and this is a big issue because it's one of the country's few remaining investment-grade builders. Well, you can imagine it's not going to be the investment-grade builder for long, and when the big ones, the investment-grade ones, start to go, there's going to be a mad rush out of these property developers as investors flee, dump their stock. You'll see it crash, and then, of course, that will all come back to consumer confidence. They won't buy, and the banks are going to be sitting on a massive amount of unsecured loans against developers that are insolvent. Beijing will be at the forefront of the next financial crisis, and here we can see it in this latest phase-to-close scrutiny from shareholders and creditors following defaults by industry giants such as Country Garden and China Evergrande. Developer shares and bonds have slumped on Monday, and sign of renewed worries about its debt woes is what's happening is the market is starting to figure out that there's no chance these companies are going to be able to pay back their debt. Maybe they can get new loans from the banks because Beijing's forcing the banks to lend, but at the end of the day, it will not be enough to pay off everybody and get these companies turned around. That's why investors are rightfully fleeing. And Monday's declines across the board were fueled by recent reports that the company is negotiating with lenders to delay payments because, well, they're out of cash and the latest cause of concern for its repayment abilities. And here, this round of rumors has materially damaged the confidence level on Vanke in an already shaky market. But there still should be some sort of support against the backdrop of government policy. Well, the reality is government policy only works when people believe in it. In this case, what they're seeing is these developers have no money. They're being forced to try to borrow more money just to clean up their debt. That doesn't mean they're trying to actually do anything else here. Consumers see it. They're backing away of what is now a ticking time bomb in the Chinese economy that's going to spread all across the world. And that's going to cause confidence, not just in China, from Chinese consumers, from consumers around the world. In fact, even here in the U.S., as the Fed chief comes under fire. And U.S. consumer sentiment post-surprise drop from initial reading, this going to Friday, as we see the University of Michigan Sentiment Index decline to 76.9 from a preliminary reading of 79.6. Now, what we can note here is that if everyone's believing in this soft landing or potential no landing scenario of the economy, then one thing that should be leading here is consumers' confidence, because they should be seeing this and experiencing the economy start to turn around and gain traction and grow, and they should be responding that with stronger outlook. And of course, not only that, but current sentiment University of Michigan saying, well, that didn't quite happen here. And the earlier February reading, which included interviews through the 14th, was the highest since July 2021. Yet gas prices climbed notably toward the end of the month, which the survey didn't specify what led sentiment to deteriorate so much through February 26 when the final responses were collected, suggesting that something in February has changed the minds of U.S. consumers in a material way. And while there's usually only one thing that can really get people to believe that this soft landing or no landing scenario is highly unlikely, and that is, of course, the labor market. And here we can see the University of Michigan consumer sentiment data. Mind you, this is not picking up that final reading here against continued unemployment claims shown in red. And one of the challenges here is you look at the link to confidence in the labor market, and it makes perfect sense. When consumers are working or believe that they can go out and get a job or a better paying job, well, their confidence increases not only in the present, but over the future in terms of what they can spend. But the problem then it comes when people get on unemployment and stay there, well, confidence tumbles. As you can see here in this chart here, we can note that University of Michigan consumer sentiment plunging here in blue as, of course, continued claims head higher. This in the late 80s, early 90s. We can go back to the 80s. We see the same trend. We see it going into the dot-com bubble. You see it happening again leading into the global financial crisis. And now we've seen this big surge in confidence that's starting to roll over because continued claims are just shy of 2 million, and that is a dangerous number because what we've noted over the past several weeks on this show is that number isn't coming down in a marked way. In fact, there are some weeks it drops a little bit, but overall the trend continues now to push higher. That erodes confidence. When confidence goes, spending goes with it, quite along with inflation. In fact, the current condition gauge fell last month to 79.4, and a measure of expectations, this is looking out to the future, dropped to 75.2 from January, suggesting across the board consumers are less confident. And again, this all backs into spending as buying conditions for durable goods ease, as did consumers' expectations for their personal finances. Again, it all comes back to the labor market, and then we look to what other pressures consumers are going to face here, and OPEC did absolutely no favors now to U.S. consumers. In fact, they're going to make it much worse. As we see, OPEC Plus extends oil cuts with Russia bolstering its effort, and their effort is to drive prices higher, which would push inflation up and put further pressure on Chair Jerome Powell's move to get inflation down, eventually cut interest rates. And this is why this week he's coming under fire in a big way, as you'll see here in a bit, as the curves, which on paper total roughly 2 million barrels a day, will remain in place until the end of June. This is dangerous because Russia promised to strengthen its role by focusing more on cuts to production than exports. We'll see if they do that, because Riyadh needs crude above 90 a barrel as it spends billions on economic transformation that spans futuristic cities and sports tournaments. Its largest partner in the alliance, Russia, also seeks revenue to continue waging war on Ukraine. And this is a problem because at $90 a barrel, that's the price they need to fund all their fiscal deficits. Underneath that, where it is now, well, they can't do it, forcing them to cut production more and more. And all this does is put higher prices on crude oil, which eventually backs into the energy sector and gasoline. This is what consumers see, the labor market that is not healing, and price pressure going up on the discretionary side, forcing them to cut back their spending more and more. And they're starting to piece the puzzle together, say, wait a minute, if spending continues to fall, well, the job market is going to go in a big way. And these latest output curves with deepened reductions made last year will be returned gradually subject to market conditions. Well, that's not going to happen anytime soon because demand isn't coming back. As we note that there is a sensitivity in terms of consumer sentiment to crude oil prices. Here you see the University of Michigan Consumer Sentiment Survey back in blue against West Texas Intermediate crude in red. And what do you see tumbling consumer sentiment? Well, that also not only matches an increase in initial continued claims, but it matches an increase in crude oil prices as consumers start to face periods of prolonged unemployment against higher energy prices and say, hey, you know what? This doesn't work. In fact, you can see it here again during the global financial crisis, during the dot-com bubble. You see it coming out of the pandemic as confidence tumbled and crude oil prices rise. As crude oil came down, confidence went up. But now, under the pressure of higher energy costs, consumers are starting to have to face the ultimate, which is going to be cutting back their budgets in a big way. But this isn't giving the Fed chief an escape, because he goes to Congress this week. The question is, will he keep his job when this is all done? Well, Powell to place pressure on rates from Democrats on terms and bank rules from Republicans, as everyone wants the Fed chief to do something other than he's doing now, as the pressure usually comes from one side or the other, and this time it's probably going to be coming from the Democrats, because the Fed has drifted more hawkish this year. They don't want the economy to roll over accidentally. The problem is it's already rolling over. Many of you noted this in the comments. Look, Steve, we're in a recession. Yes, and by all metrics we are. The labor market is just getting started on its trend of higher and higher claims here. And this is bad news, of course, for the Democrats who are looking to keep the White House. And they don't want it to roll over, because when it happens quickly. And to the Democratic Party right now, that is indeed a massive risk. You can forget about all of those banking things that are going to come up on the Republican side, because we're going to have a banking crisis anyways. There's going to be a massive amount of heat on the Fed chief as he goes there and tries to convince them that, yes, we need to keep rates elevated. The economy is strong. And what you're going to see in a matter of months, the opposite is going to happen in a big way. As Powell has repeatedly said, the looming election plays no role in policy decisions, but some Fed watchers worry rate cuts this year, as investors are betting on the first reduction will come by June, could be perceived as the Fed giving a boost to Democrats. So here you can see panic on all sides. Those from the political elites in China who do not want to admit that, in fact, their property market is not going to be able to be saved. It's going to lead to an all-out banking crisis. And here in the U.S., we see a loss of confidence and the pressure coming onto the Fed chief to cut rates before the U.S. economy slides down into recession. But one thing we note that investors have a lot of confidence right now, and that is the stock behind our sponsor of today's show, Telemere Pharmaceuticals. You can find them on the NASDAQ under symbol TELO. Let's take a look at this company and why I think the stock could be rapidly squeezed higher for a 10 to 20% quick gain. And all the information in the comment and pinned comment and description below. Here you can see they are looking to develop and commercialize the first novel small molecule to lengthen the DNA's protective telomere caps in order to affect age reversal. Here you can see they just went public, and here we note that the company is focused on the development and commercialization of telomere 1 as the first novel small molecule to lengthen DNA's protective telomere caps in order to affect age reversal. This was announced on February 13th with its initial public offering, and this company has got a co-founder, chairman, and chief executive that the market really believes in. Chris Chapman serves as the appointed director from Metre Pharmaceuticals. You may remember them. They've been a sponsor on this show before. And prior to joining Metre, and since 2015, Dr. Chapman served as the current president, chief medical officer, and director of MyMD Pharmaceuticals. This guy is a big hitter, and the market likes him because telomeres are at the end part of the chromosomes that serve to protect the DNA, just like shoelace tips prevent shoelaces from unraveling. When the telomeres shorten to a critical length, the cell stops dividing and either becomes senescent or undergoes apoptosis. And telomere shortening has been discovered to be the primary cause of human aging, as short telomeres have been associated with almost all age-related chronic diseases. And we look at some of these, such as cancer, anorexia, type 2 diabetes, Alzheimer's, and more. And this would be a big solution for the market. And one thing that we think will be a big boost for your trading account is, again, the stock price. check this out. We're looking at this big squeeze here on the NASDAQ, symbol TELO. Let's take a look at their chart. Now remember, this went public, and it's not unusual to see stocks get crushed after going public, which just goes to show that the market really loved Telmere. They IPO'd, and the stock rallied up all the way up to almost $21, pulled back and is settled right here on this volume profile line, as again, buyers and sellers are equal here, suggesting that any push higher in price could send the stock launching. Well, just how much? Well, as we zoom in here to the 10-day chart, you can see back here within 10 days, the stock got squeezed up to $11, suggesting that a potential $2 return here on a $9 stock could be a huge squeeze higher and maybe send the stock even further up from there. Again, Telmere Pharmaceuticals on the NASDAQ on the symbol TELO. And as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.